In this video, we're gonna focus more on the content of the balance sheet. I want you to all know exactly what each point of the balance sheet means. It's gonna help you out a lot during any exercise or any analysis you have to do. First of all, of course, we're gonna look at assets, liabilities, and finally, approach the owner's equity. So, when we look at assets, it's worth it that we look first at current assets. Whenever you're writing your balance sheet, it's better for you to put assets, current assets, analyze the current assets, then put non-current assets, and then move on forward, as well for liabilities. In this case here, as a current asset, we'll have cash first. Of course, it's the most liquid, is the most current of your assets. You would have the receivables that I like to note as accounts receivables, AR is the easiest and fastest way to write it. You have as well inventory. In our case, we'll talk about inventory of food. It's something current because you sell it every day. We're not talking here about equipment, land, building. We're talking about current inventory, like food. The fourth one is prepaid expenses. This, for example, if you pay an insurance for 6 months, you can cancel that deal. It's something very current. It's short term normally. Marketable security is a short term investment. For example, when I want to buy some stocks, buy some shares of a company, the thing that they have in common is they're all until 1 year. That's why we call it current. They're not going to be long-term investments. We're talking about small investments. We're talking about small time prepaid expenses. We're talking about an inventory that moves every day. Receivables that we're expecting to get in less than 1 year. We can call it as well, to be more precise, current receivables. The ones that we're expecting to receive in less than 1 year. The ones that we're expecting to receive, of course, in more than 1 year, will be the non-current receivables. After the current assets, you have to take a look at the non-current assets. This would be, for example, the long-term investments, the ones that you're expecting to get money from investment, a return of investment after 1 year. So all of this for 1 year plus. The property or equipment or even land, we'll note it down here, land. They are non-current assets, they are fixed. They will last longer, they will last more than 1 year. They are not just easily moved. They don't have a very strong flow of buying, selling. Next one would be an intangible asset. What is intangible? Intangible means that you cannot touch it, as the opposite of this pen. Goodwill means, let's say, good mood, or let's say it's hard to explain goodwill. It's when you're being nice. Goodwill is when we're being nice. When you're selling a company, for example. I'm selling my company to you. My company costs 200,000. And I tell you, my company costs 200,000, but my goodwill is very strong. My goodwill means that I estimate that my company is worth much more than 200,000, because I had a lot of effort of getting inside the market. I had a lot of effort with my brand, which is intangible. You cannot touch my brand. You can perceive it, you can look at it, you can assimilate it with values. You can love it, you can hate it. You cannot calculate how much it costs. I can estimate it. It's my company. The value of my staff, of my management. So when I sell my company to you, I'm not going to sell it for 200,000, which is what it costs. My goodwill is an asset. My goodwill will make my company costs even more, because I estimate that she's not only worth what she's really worth. Now I'm gonna show you a little bit of the liability side. The liabilities, which are things that the company must pay, didn't pay yet, are sort of a debt, would be divided first. You look first at the current liabilities, which means less than 1 year, more liquid, more current. First of all, you look at the payables, accounts payable. Accounts payable is, for example, when you buy something from a supplier and you told him I'm gonna pay you at the end of this month or at the end of this year. See, there's a time constraint of 1 year. That's why I write AP, accounts payable. It's easier for you to write it when you're noting down your balance sheet in the exercise. Salaries payables, as you get the idea, is when you have to pay the salaries. You didn't pay the salaries yet. You recorded it as expense because it happened. It's one of your expenses to pay the salaries of your staff, but you didn't give them the money yet. The cash didn't leave, so you record it as a salaries payable. You have to pay the salaries. When you do your net income, you have to subtract the taxes. For example, the government will look at a company who's earning this amount of money, so they will give this amount of taxes. If your company is making much more money, then the taxes will go up. It's all linked to the net income and the income statement. Payable means that you didn't pay it yet. The government is waiting for you to pay it. You get now the idea. Dividends payable. Dividends are money that the company gives to the shareholders, to people who own shares, people who own a piece of the company, people who invested their money and they put trust in the company. They will receive a dividend, which is an amount of money, which is very good for you if you want to invest in a company. Every year the company will give a certain amount of dividends for people who own shares. If you have 100 shares, you're gonna get a big dividend. If you have only 2 shares, you're not gonna get as much as a dividend. Payable, because you still didn't pay it. You must pay it within 1 year. So, on the other side of the liabilities, we have the non-current liabilities. This will be the notes payable. These are notes. They are signed within an agreement with 2 companies, and it's like an accounts payable, but it will take longer. It will take me longer to pay the supplier. It will take me more than 1 year to pay him. Mortgage payable, it's more linked with the usage of land, of equipment, something like I'm paying the rent of this house. It's gonna take me, maybe I can pay it like in more than 1 year. Maybe it's gonna last even 20 years, some mortgages. It's all about the time. Non-current liabilities, they last more than 1 year. Just as long-term marketable securities, which is again, market securities are investments. I know that in the previous video I mentioned that market securities were short-term investments. It's not actually the truth. The truth is that you have long-term and short-term marketable securities. So, owner's equity now. First of all, we talk about capital stock. What is capital stock? Capital stock, it's, let's say, all the shares outstanding that you have. It's called normally the common stock. It would be, for example, the value of 1 share multiplied by the number of shares you have. Shares are pieces of your company. You can allow people to buy 50% of your shares, or allow people to buy only 10% of the shares you have. And the shares might be, let's say you are issuing 100 shares, and the value of them is 2 francs. So in total, you have 2 times 100, 200 of capital stock. Some companies, they prefer to have only common stock, which is normal for the hospitality industry. We prefer to use common stock normally. And on the other side, we have preferred. The common stock is what we just talked about. The value, the issue shares, people would buy it for a price, etc. Preferred stock is when you issue shares that will have some sort of preference when I have to give my dividends. As we said, dividends is, let's say, a sort of retribution for people who invested and buy your shares. So preferred stock would be people who own preferred stock, might be 1 person to 200 persons having preferred stocks. These people would receive dividends in preference. They would have the preference of having dividends. If I cannot pay dividends for my capital stock as a whole, but I can still pay some sort of dividends, I'll give them all to preferred stocks before, and if I still have some, I'll give to common stock. As well, if in this year I couldn't give dividends at all, I'm gonna give next year, I'm gonna pay first the preferred stock what I didn't give them the previous year. So they have the right of accumulating what I didn't give to them, or accumulating what I didn't complete it. If I should have given them this amount, I couldn't. I just gave them a lower amount. Next year I'll have to payment what I agreed with them. They have a preference agreement. The next point of the owner's equity is the additional paid-in capital. So as we said, the shares of the capital stock from these 100 shares, they have a value of 2 Swiss francs, $2. However, when I'm gonna sell a share, I'm not gonna sell it for 2. I will sell it for 10. So I'm gonna record as capital stock, common stock, par value 2. I issued 50, so I'll put here it was 50 times 2, 100 common stock, just the par value and the number of shares issued. And on additional paid-in capital, as I say, we're selling it for 10. The par value is 2. So, what is the difference? 2, 10? The difference between 2 and 10, 8. So, I'm going to have additional paid-in capital, 8 times the number of shares I sold, 50 here. So 8 times 50. Is 400. So at the end of the day, you will increase your owner's equity according to what you just received. 400 here, 100 here. So you have an increase in owner's equity of 500. Which basically explains, because you sold 50 by 10, 50 times 10 equals 500. It makes sense. Retained earnings. Retained earnings are amount of money that you collected but you still didn't distribute it, and that you still didn't subtracted dividends. This is very important, and we'll see it in detail when we're going to talk about income statement, net income. For example, when you finish your net income, you're going to add it to the retained earnings. You know, it's an amount of money that has not been distributed yet, that has not been buy as asset or converted into liability. It's like your piggy bank, some money that you keep in the company, and it shows that. In theory, it should show that every year it grows, that you're having more money for you. It means that if you have good return earnings, you're going to have good dividends, because dividends, they come out from here, retained earnings. The last point I wanted to talk about is treasury stock, something we didn't see in Glion in second semester. Treasury stocks is when a company buys their own shares. So they would go to the stock market and buy a piece of their stock. Why do they do that? there are many strategies related to treasury stock. Everyone knows that the price of a stock, the price of a share, is linked to a demand and supply ratio and risk management and betting or estimating that this industry is going to work. There are many factors there. One of them is demand. If there is a huge demand for that share, the price will be more, the share would be more attractive, and therefore you can increase the price of your share. And that's why treasury stocks are here. If I see that the price of my shares are going down, me as a company, I'm gonna go buy it. It will create some sort of demand and the price will go up again. That's treasury stock. Before you think that we're finishing the video with owner's equity, I wanted to present the last, yet I think the most important part of the balance sheet. Something that as well we didn't think are the footnotes. Footnotes, as the name it is something that you would find at the bottom of the balance sheet with some notes, explanations about the balance sheet. They will give important information to explain, for example, the retained earning per share. They will explain the goodwill of the company. They will translate, for example, from US dollars to Saudi riyals to Swiss francs. They will give all the necessary information that you must know for you to analyze properly the balance sheet. So this as well is something you should take in care. You should take in account when you're doing your project, reading the footnotes, because they are explaining everything for you. They are showing all the information for you to understand better the balance sheet.